What's up, apes? Welcome back to the Daily Peels podcast / video stream of the day. My name is David. Thank you for joining us once again on this beautiful Tuesday, July 16th, 2024. It is currently 8:03 p.m. and we got a lot to talk about here today. I know I say that every single day, but I actually mean it today. But before I get into it, shout out to a very wise ape, quite astute, maybe the wisest ape out there for catching something that I didn't even realize that you guys can see in these videos, but he did notice that I hadn't changed the date on my calendar since about June 20th as of yesterday. So appreciate that somebody's doing their diligence because I know I am absolutely not. Now, with that said, we're going to dive into bank earnings reports today. We're also going to talk about why Jerome Powell is causing uncertainty by creating certainty in the market and other, takes, and just, we're creating content. It's entertainment as much as it is information, right? So we're just throwing shit out there and seeing what sticks. So let's go ahead and get into it. First of all, absolutely phenomenal day for the apes at WSO Alpha. They heard me yesterday talking about how I was ready to fire each and every single one of them, and they turned it around today because we had a big update. We were up about 89 basis points for the session. So that was compared to, I don't have it pulled up right now, but I believe the NASDAQ was up about 60 basis points. Let me go ahead and pull it up. Actually, the S&P was up 60 basis points, 64 basis points to be exact, and the NASDAQ was up a fucking embarrassingly pathetic 20 basis points for the session. Tough day for big tech as people are starting to realize that there are other stocks in the market. And in fact, there's 493 other stocks in the S&P 500 that they can still go ahead and buy. It looks like a rotation into smaller caps is still underway, especially today after what Powell said about rates, which we'll get into at the very end of the video / podcast. Okay, so the Alpha portfolio, the reason we were up so much today, once again, goes back to Powell's comments on rates from today. Basically, all of our home builder stocks were through the fucking roof for the session. Builders First Source was up something like 8.03% around there. Zillow was up 4.39%. We have exited DR Horton, so that is no longer in a portfolio. I shouldn't have fucking said that. That's Jesus Christ. I gotta get better at what I disclose here versus what's reserved to the premium subscribers. Anyway, go ahead and everybody subscribe to WSO Alpha so I don't have to pay attention to what I'm disclosing to the public. Just make my job easier for me, okay? Anyway, let's get into some of the banana bits for the session. So, first and foremost, markets are getting a little bit crazy. We're starting to price in 3 cuts before the end of the year in the federal funds rate. So people are starting to say that maybe we could get down as far into the range of 4.75 to 5%, maybe even 4.5% to 4.75%. I know that sounds absolutely insane, but still, it is what they're talking about. And on the street, it seems like it's becoming consensus. Donald Trump would say everybody knows it. Everybody's been saying it. It's the best rate cuts of all time. Something like that. And, I can't get him out of my mind after this assassination attempt, to be quite honest with you. But nonetheless, everybody's talking about it. That's what consensus expectations are right now. Let's go ahead and move on into our next banana bit. First up, we have United Health Group. This is one of the largest health insurance providers in the United States. They had a very solid earnings day. The stock was up quite a bit despite the ramifications of leaking the medical histories of basically every American that they've ever insured via a hack that happened earlier this year. It still worked out well in the second quarter. Moving on down below, I am starting to question if the International Monetary Fund, the IMF in other words, if they've ever taken a macro 101 class because of this analysis that they published. Quite honestly, after I read into it, it did make sense, but on its face, it just seemed absolutely absurd, if anything. But nonetheless, definitely go ahead and check that out with Wall Street Journal's reporting. And finally, 𝗟𝗓𝗔𝗡𝗗𝗅's back to bullying her crush, Amazon.com Inc., with yet another challenge to an acquisition that Amazon is pursuing. This one is of a small AI startup, and 𝗟𝗓𝗓𝗔𝗡 just fucking has it out for Amazon. That's the whole reason that she's the FTC director, is because she wrote her doctoral thesis in law school on breaking up Amazon. And so Biden and Kamala were like, we would fucking love to do that. Will you please work for us? And she was like, absolutely. I'm going to go in there. I'm going to break them all up. And almost 4 years later, they're all still doing just fine. So, it clearly hasn't worked out as originally intended, but overall, I would say that's probably been a good thing for most consumers. Okay, let's go ahead and start talking about our main story of the day. Finally, we can talk about bank earnings. I've been waiting for this since fucking Friday morning of last week, which feels like forever ago. Trump wasn't even assassinated on before then, so pretty crazy if you think about it that way. But nonetheless, banks started reporting earnings last Friday with JP Morgan and Wells Fargo, Citigroup kicking us off at the end of last week. We got Goldman on Monday, and then today we finally got numbers from Bank of America, and Morgan Stanley. So we're breaking down all of those earnings reports. It is a very long daily peel for you guys tomorrow, but sometimes you got to do what you got to do. So kicking things off with the Death Star themselves, JP Morgan, they lost 1.21% on the day of their earnings release, despite beating across the board, having one of the absolute best reports. Actually, I think that's the third best performance on the day of the results out of the entire set of these 6 major banks in the United States. But still, nonetheless, they looked overall solid. They reported $4.26 per share on $50.99 billion in revenue. Expectations were for $4.19 per share on $49.87 billion. Investment banking fees completely blew up 52% compared to last year. So there is job opportunities out there for all you apes clamoring to get into investment banking. The street, however, was more focused on other things, particularly the surprise in provisions for credit losses. Those came in at $3.05 billion instead of the $2.78 billion that was expected. That kind of suggests that JP Morgan is feeling a little bit nervous about their borrowers, but nonetheless, they don't really have too much to be concerned about, especially if you look at some of these basic numbers from their report. So we're still seeing an extremely high, in fact, a street leader in ROTCE at 28%. We're seeing CET1 ratios up in the lower 15 range. So we're at 15.3 for the standard CET1 ratio and 15.5% for the advanced CET1 capital ratio. Now we're also seeing 1.7 trillion in standard risk-weighted assets. So overall, a very healthy looking balance sheet. That's kind of why they're called the Death Star. And we'll talk about another reason why they're called the Death Star in just a quick second. But before we get into that, let's talk about another stock that reported on Friday. Wells Fargo, this company, they're particularly good at scamming customers and not adhering to regulations more generally. And that definitely showed in their earnings report. They were down 6.02%. On the day that they released earnings, so last Friday, they were down 6.02%, much more than JP Morgan. It was an absolutely disgusting report, and the worst thing was a 9% decline in net interest income. So that was very idiosyncratic. Nobody else did that terrible, and it's because of Wells Fargo's overexposure to consumer banking. So each one of these banks, they do all play some role in every facet of a large financial services company, from advisory on mergers and acquisitions to holding your checking account. They all do some form of that or have some presence in each one of those markets. Wells Fargo is much more exposed to the consumer side than the Wall Street side, so they suffered pretty heavily from that because it was mostly a Wall Street rebound that was powering these earnings. Nonetheless, they did still beat with $1.33 per share against expectations for $1.29 on revenue of $20.69 billion when they were expecting $20.29 billion. Now, net margins, average loan balances fell, particularly within their corporate and investment banking division. And I think, obviously, this was a much uglier report compared to JP Morgan. And I don't think there's any better way to represent the difference in these earnings report than simply just looking at the architectural style of the headquarters of these two companies. And if you're watching the video, you can see exactly what I'm talking about right here. I didn't cherry pick these images. I promise you, I went to Wikipedia and looked at the images of their headquarter buildings. Wells Fargo kind of has two. One is here in Charlotte, which is equally, actually, I wasn't, fuck, now you guys know where the Daily Peel Global headquarters is. But anyway, I'm leaving in a month, so fuck it. Here in Charlotte, the Wells Fargo building is equally disgusting, but it's just not in this brutalist architectural style that they have out in San Francisco, while JP Morgan looks like a building of the future. It looks like the global headquarters of fucking Oceania in 1984. Like, that's basically the kind of vibe that it's giving off for us. That's why we call it the Death Star. This bank is just, it's unbelievable how well the JP Morgan has done over the past couple of years, especially compared to all of these others. Okay, let's move on down into Citigroup. So Citi also reported on Friday. They were down 1.81%. They reported $1.52 per share on $20.14 billion in revenue against expectations for $1.39 per share in earnings on $20.07 billion in revenue. So once again, just barely beating expectations. It's almost like these banks game the system or something a little bit in order to just barely beat. But nonetheless, Citi is extremely exposed to the Wall Street side of the business. So obviously, they were looking particularly good in Q2. In fact, if you thought JP Morgan's 52% revenue growth in investment banking fees was impressive, wait until you hear this. Citigroup's IB fees grew 63% for the quarter. So absolutely, completely dominating everybody else on the street. Now, at $853 million in total investment banking fees, that is still roughly 37% of the size of JP Morgan's. So, you know, it's not like they're taking over the industry or anything. They had the fastest growth because they're starting from the lowest base point. But nonetheless, it was still good stuff for Citigroup. They also saw trading revenues in equities as well as fixed income. Equities trading revenue actually grew 37%, which was the most for this segment for anyone in the competitive set, while fixed income revenue somehow fell 3%. 2%, even though everybody else was making money off this. But I guess we know whose money they were taking. It was coming from Citigroup and going into the pockets of our next company, Goldman Sachs. Goldman, this is our first stock that was actually up on the day after their earnings, up 2.57%. DJ D. Saul, the CEO of Goldman Sachs, David Solomon, he is a part-time DJ. Look that up if you don't believe me. He is staying gold just like Pony Boy. He's even finding time to go DJ parties on Memorial Day weekend out in the Hamptons. But nonetheless, Goldman saw a revenue of $12.73 billion, growing at 17% compared to Q2 of 2023, the fastest growth of the competitive set. Trading revenues, advisory revenues, and asset and wealth management revenues were all completely on fire. Let's go ahead and check it out right here. This is where we are seeing asset and wealth management net revenues. This is where you can see the growth. This is the second quarter of 2023. This is last quarter, Q1 of this year. And then this is Q2, the current quarter that we're talking about. We can see that most of the growth came from equity investments and incentive fees. Incentive fees more than doubled compared to the quarter last year. So looking very good. Wealth management is also basically the only area of finance that is secularly growing. So these banks are going balls deep into that. Everybody wants to snatch up as many assets as possible. Okay, moving on down to our next one, we have Bank of America. They just reported today they were up 5.35% on the session. So a very solid day for Bank of America. This is the second largest consumer bank in the United States, so very exposed to the consumer side, but they still managed to fare far better than Wells Fargo did. So they reported 83 cents per share on $25.54 billion in revenue against estimates for 80 cents per share on $25.22 billion. Once again, just squeaking past those estimates. Net income fell a not so nice 6.9% to miraculously $6.9 billion, which makes this the best earnings report that I have ever seen in my entire life. They saw a 29% increase in banking fees. Asset management fees jumped 14% to an all-time record. And we can take a look at some of their deposit trajectory right here. All of it is moving lower, which is definitely not a good thing for a consumer bank because this is what they use as funding for the loans that they give out. It's going to be more competitive to get these funds. So deposit fees, expect APYs to start going up. Nobody's going to come close to SoFi, like the 4.6% range. We can at least get off JP Morgan's death rate of 5 basis points. Anyway, let's move on into our last bank earnings report of the day, and that is, of course, going to be Morgan Stanley. So a very Wall Street exposed bank. They were up 84 basis points for the session, so 0.84%. For anybody who's not a virgin loser finance bro that knows what BIPs are, up 0.84%. Beat estimates for revenue and earnings by reporting $1.82 per share on $15.02 billion in sales, against expectations for $1.65 on $14.3 billion. That's 12% revenue growth and a massive 41% jump in profits. Firm's wealth management business completely shit the bed, however. They grew just 2% on a horrific 17% decline in net interest income. So it's very ugly on that side of the business. Again, this is the only secularly growing business within finance, and Morgan Stanley shit the bed with it. They have been a street leader within this segment, so it's not too surprising when they're starting at such a high base and all the other banks are attacking asset and wealth management as quickly as they possibly can. They did see equities trading revenue up 17%, fixed income up 16%, taking all of Citi's money. So overall, a still decent quarter. So a couple of big takeaways here. First and foremost, Wall Street is back. In case you were curious, Wall Street is absolutely back here in 2024. We're seeing investment banking fees jump. We're seeing equities trading revenue and fixed income trading revenue back moving in the right direction. And that is, of course, up and to the right, starting to make more money off of this. We're also starting to see another big takeaway here is that lower end consumers are starting to look a little bit worse. That's a big reason why we're seeing this deposit play. It's a big reason why we're seeing slower loan balances because nobody wants to take credit, and those that want to take credit don't qualify for it. So again, somewhat concerning trend, especially for those banks dumb enough to be overexposed to consumers. Why would you trust that in a million billion years? But nonetheless, those are kind of the biggest things that we see going forward. All right, this is already way too long, but let's go ahead and move into some of our big stock movers of the day. First and foremost, we have Match Group up a massive 7.5% for the session. They found a little bit of romance of their own. That's from Starboard Value. This is a hedge fund that has taken an activist position in Match Group. Now owns about 6.5% of the dating app company. For those that don't know, Match completely runs your dating life. So about half of relationships in the US are now started online. If yours is starting on Tinder, if it's starting on Hinge, if it's starting on basically anything that's not Bumble or Grindr, then it probably started with Match. Plenty of fish, you own Farmers Only, that's Match Group, okay? So everybody's meeting on Match Group, and they're starting to meet up a romantic interest of their own, so we're pretty proud of them. Once again, like I said, the hedge fund disclosed a 6.5% stake. Starboard CEO Jeff Smith, he said he wants to improve specifically Tinder and Hitch because apparently he wasn't getting any matches. I can't imagine what the other reason would be, but nonetheless, Tinder accounts for about 50% of Match's revenue alone, so they're looking to improve on that. I don't necessarily know exactly what more you could want if you're trying to get that up to 60% of revenue, but it seems like it's all the other apps that you should be focused on. Nonetheless, I'm pretty sure Hinge is the only actual one that people want to meet somebody and like get into a relationship with them on. Tinder is more of a meat market, for lack of a better word. But nonetheless, the stock was up 7.5% as investors are excited about the potential help that they'll be getting. Okay, moving on down below, we have State Street up 7.5%. This is the boomer company of all boomer companies. The bank was founded in 1792 in Massachusetts from a charter from John Hancock himself. Yes, that John Hancock, the big signature on the Declaration of Independence. He chartered this company start in 1792, and I think yesterday was the company's best day since receiving that charter. So the world's 5th largest ass man, obviously I mean asset manager, get your fucking mind out of the gutter. Once again, they beat EPS by 6.97%. They beat on revenue by 1.35%. Assets under custody and assets under management both hit an all-time high, with under custody at 44.3 trillion and AUM at 4.4 trillion. That might make them the 4th largest asset manager in the world. They're kind of going back and forth with Fidelity because it goes BlackRock, Vanguard, UBS after they bought Credit Suisse, Fidelity, and then State Street. And the top 3 there are a little bit interchangeable, but nonetheless, it was a good day for them. Interest income was up 6.4%. Fee revenues grew 1.5%. There was an 11% hike in the cost of management fees. We've been talking a lot about, obviously, inflation, just like everybody and their fucking mother has been. A big driver of the CPI in the past year or so has been investment management fees, and we just found the culprit right here. It is State Street. Okay, moving on down into our next stock mover, we have Charles Schwab. This is a fellow ass man, but they did not do quite as well for the quarter. They were down 10.2% for the session. We hold this company in the WSO Alpha portfolio, so that was definitely not a great feeling. We actually hold this on Schwab, so we lost money in Schwab on Schwab. So a very terrible day in that regard. Usually, obviously, as you guys know, we never lose money in WSO Alpha, but Charles Schwab certainly does because net income fell 3% for the year. But if we actually look at fundamentals and kind of the flows like we talked about with BlackRock yesterday, really wasn't that bad. Core net new assets grew 17%, very strong growth compared to State Street and BlackRock and other competitors so far. We also saw managed investing solutions. These had inflows of $56 billion for the quarter, much higher as a percentage of total assets than something like a BlackRock, which isn't very hard when your competitor is $10.645 trillion. Schwab is a shit ton, but it's definitely not even worth saying in the same breath. They also saw client assets receiving advice grow 16%. So these are assets that you can charge very high margin fees on. And they also saw brokerage accounts grow 4%. So all the activity is moving in the right direction. They got to monetize a little bit better. And one of the big problems is that Schwab has a long duration balance sheet with its bond portfolio. So we've talked about this a couple of times. Companies, especially finance companies like banks, they will hold a couple of different kinds of assets on their balance sheet, but the important ones as it relates to Schwab are what we call available for sale and held to maturity. Available for sale are basically bonds that you're saying, yeah, we're going to buy this shit and we might sell it if we need liquidity. And then held to maturity is you're saying, we're going to store money here, we're going to earn this rate of return, and we are not going to sell these under any circumstances. SVB went belly up because they started to take from their held to maturity portfolio in order to cover deposit flight, and that's how everything kind of unraveled. So Charles Schwab, if they were to do the same thing, it would almost undoubtedly cause the same kind of panic for them. That's not going to happen because they're not as dumb as SVB, but they are having to allocate a lot of the money that would go to things like buybacks and investments in the company, or maybe even acquisitions, to reshoring their balance sheet and trying to plug some holes from being so long duration. Now, it does seem like being long duration is going to be beneficial going forward because when interest rates are lowering, then the principal asset prices of those bonds tend to increase, and they tend to do so at the highest magnitude, the longer end of the curve. That's exactly what we're talking about when we say duration. All right, moving on into our last stock mover of the day. Jesus Christ, have I been talking for 5 hours at this point? But we have Reddit down 3.5% for the session. It's I mean, it's poetry that literally yesterday on Monday, Cramer was out there and his exact quote was, buy, 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 when talking about Reddit, and now the stock is down 3.5% on the session. Clearly, Loop Capital was watching CNBC at the time. They said, if Cramer's getting into this, we want fucking out. And they cut their rating from a buy to a hold. They maintained a $75 per share price target, which is roughly 2% growth from Monday's close. So absolutely nothing whatsoever. They did also point something out that I hadn't actually noticed, which is 82% of Reddit's outstanding shares are... Well, so let's back up for a second. Most of Reddit shares, the vast majority of them are under some kind of... They're held by insiders. And most of the shares held by insiders, 82% of them, are under a lockup period, and that lockup period is going to be ending on August 9th. So that basically means insiders are going to be able to sell 82% worth of the float of Reddit stock. That doesn't mean that they're going to. They're definitely not, because the stock would completely crash if they were to do so. But we're going to see increased selling pressure just based on the simple fact that these insiders are now, they're able to pursue liquidity events by selling shares if they really wanted to do so. We'll see if it actually happens. Okay, moving on down into our final story of the day. We're going to make this real quick, but we're of course talking about Dancin' in September. Wonderful song by Earth, Wind & Fire, and nothing could describe what 𝗟𝗂𝗚𝗏 said yesterday more perfectly. So it's very hard to be 100% certain about anything. I'm not 100% certain that I'm speaking to you right now, but Powell's cutting in September. The market is 100% certain about that. They are very confident. We can see that represented by this chart from the CME Group right here. So I know we talk about this chart a lot. Let me go ahead and take a second to actually explain it. Basically, these blue bars are probabilities for interest rates falling within a certain target range at a given date. So we can see the given date up here. This is the 18th of September, 2024. So immediately following the September FOMC meeting. What we see right here, this is the target range of 500 to 525 basis points, aka 5% to 5.25%. And the odds of rates ending there at the end of the September meeting sit at 90.5%. Translation, there's a 90.5% market implied odds of a rate cut happening at the September meeting, of 125 basis point cut happening by the end of that. So that implies that there's going to be no cuts in July and only 125 basis point cut in September. Moving on down below to the target range of 475 bips to 500 bips. That's sitting at 9.3% on, so that could imply either a 25 basis point cut in July and a 25 basis point cut in September, or a 50 basis point cut at the September meeting. Then finally, the same odds of my parents ever becoming proud of me at 0.2% towards the very end here is the range of 450 to 475 bips. That would basically imply that there would have to be 75 bips worth of cutting, which is definitely not going to happen by the September meeting, but the market seems to think it will by the end of this year. That's what we were talking about at the very top with our first banana bit of the day. So 𝗟𝗂𝗚𝗏, he was speaking at an event with the highest concentration of virgin nerd losers outside of Silicon Valley. And this is called the Economic Club in Washington, D.C. And there was one quote that caused all of this. And that quote is, if you wait until inflation gets all the way to 2%, you've probably waited too long, because the tightening that you're doing, or the level of tightness that you have, is still having effects which probably drive inflation below 2%. What he's talking about there is the long and variable lag of monetary policy. This is this is what keeps 𝗟𝗂𝗚 and every central banker in the world up at night, because basically what they're saying is we're moving in the direction of 2% because of the changes that we've already made. If we make more changes, are we going to basically break the economy? If we wait too long, are the effects going to be in existence for too long, where no matter what happens, it's already on a trajectory to fall below 2% and get into a slowdown or an economic recession here in the US? That's basically what he's saying right there. So he's talking about long and variable lags, clearly concerned about that stuff. So that made Mr. Market extremely confident that Powell's going to be cutting at least once by September. And now the market thinks that there's going to be at least 3 cuts by this year. Rate cuts are phenomenal for home builders because it increases demand for new mortgages, new houses, all that yada yada. And so that's why the Builders First Source and Zillow stocks within the Alpha portfolio were up for the session. I am very much out of breath. This is easily the longest one that we've ever done. We're at 23 minutes already, and I still have to read our quote, which comes from the biggest Fed hater in the entire world, Mr. Jeremy Siegel. Very smart professor, but I would like to hear him just once come up with a solution instead of just shitting all over what the Federal Reserve does. Anyway, he said, if investors expect the Fed to stabilize the economy, this will be built into stock prices long before the Fed even begins to take its stabilizing action. So that's basically saying that, yes, if you think that, on September 19th, you're just going to wake up with cuts and you're going to, place long duration bets or buy home builders or something, think again, buddy, because this has already been priced into the market is essentially what Siegel is saying, and he couldn't be more right. That is really the great challenge of being an investing professional. What's priced in, what's not priced in? When is David going to shut the fuck up? These are the important questions of our time. I can actually answer that last one, which is right about now. Happy investing, happy trading, everybody. It's 8:27 p.m., way past my bedtime, and I will see you guys all tomorrow. Bye now.